Hello, and welcome to Nutmeg's Investor Update for January. I'm Kat Mann, Head of PR here at Nutmeg. I look after all our communications with the media. For this month's update, I'm joined by Brad Holland, our Director of Investment Strategy. Hi, Brad.
Hi, Kat.
Brad, if we believe what we saw in the news, last year was a good year for markets. How was December?
Well, it was a positive year-end for developed markets. Equity markets rose by 3% on the month, taking the year's return to 28%. The best performing markets in December were middle-sized UK stocks, up 5.4%. And the broad emerging market index, that was up 5.8%. Now, the pound sterling rose 2.5% after the UK election result reduced Brexit uncertainty. Now, in truth, markets began pricing for less Brexit uncertainty back in the summer, with both the pound sterling and mid-sized domestically related stocks doing better since August. Bond yields rose in December, which means that their prices fell, and that's a usual pattern when equities do so well. Corporate bonds did better than government bonds, also the usual pattern. Commodity prices had a good December, but that really just reversed an awful November. Apart from gold, there's been no real lift-off from the base of commodity prices.
So a strong end to the year for equity markets. What were the political and economical events that influenced these returns?
Well, I've already mentioned the UK election, and that really takes parliamentary risk off the table for a long time. Political risk, however, remains, and not least, what type of Brexit will the government manage to pull off? Elsewhere, the key trigger for December's stellar, nearly 6% rise in broad emerging market equities was the Phase 1 trade deal agreed between China and the US. That was quite a relief rally after the trade war had dragged on for 18 months. The deal will be signed on January the 15th, but it really only papers over the disagreements between the two countries. The tariff rollbacks within it are only partial, and the sticky issues of market access and intellectual property rights have been pushed into the future. Now, also in December, the US Federal Reserve kept interest rates unchanged and communicated that it was pretty happy with the way 2020 is shaping up. So it is unlikely to lower rates again this year unless things deteriorate.
And on the topic of 2020, what can we expect to see from the year ahead?
Well, there's a US election, and state primaries will soon be underway. There's also the impeachment process. How will that impact the November poll? Would a successful Democrat president reverse the tax cuts implemented by the present government? The election years are usually associated with good equity markets. So looking at all the 17 elections since World War II, only 2 of these saw declines. That's the 2000 internet stock bubble and the 2008 global financial crisis. So without a major crisis, it appears governments try and focus on improving the economy, which also improves the equity markets. So 2020 has actually begun with a geopolitical crisis between Iran and the US. Could this crisis become big enough to unsettle equity markets? Well, geopolitics can put a dent on confidence, but the modest oil price response so far does not suggest the market is overly concerned just yet. And lastly, the new year will see plenty of brinkmanship and politics between the UK and the European Union. A comprehensive trade deal needs to be struck by year's end. We expect that could be a rough ride, actually, and deadlines may need to be pushed out, but we do expect a deal to get done.
And how have the fully managed portfolios performed?
The fully managed portfolios rose by 1.3% for the mid-risk portfolios and 1.8% for the higher risk. For the full year, that meant mid-risk portfolios returned just under 13%, while high-risk portfolios delivered just under 19%.
And with this in mind, have we made any changes to the fully managed portfolios?
Yes, we increased equity exposure, taking it back to neutral levels by buying some UK, some EU equities and some emerging market equities. We had already been building up our exposure to mid-sized UK equities, and we took that position back to neutral in December, although we remain underweight UK equities overall.
Thanks, Brad. Now, this month's customer question comes via a viewer named George on YouTube. He's asked, I saw the markets increase with the Conservative win in the UK general election. Also successful was the Scottish National Party. Are you concerned about the risk of the UK breaking up due to Scottish independence, and what effect that, or the build-up to that, might have on the markets?
So thanks, George, for your question. Yes, a breakup of the United Kingdom would definitely be a disruptive event for markets. But it's hard to see how this can happen anytime soon. The Prime Minister is clear he will not grant permission for another referendum. Now, this year's Scottish parliamentary election will provide further evidence of any underlying appetite by the electorate for independence. But even if a larger SNP majority comes from the election, it's not likely to change the Prime Minister's view in the near term. His focus is firmly on getting the right trade deal with the EU this year.
Thanks, Brad.
Thanks, Kat.
And thank you for joining us. As always, if you have any questions for the investment team, please feel free to contact us via social media, email, or leave your comments in the section below. We look forward to seeing you again next month.